Most people think they know how to invest, but 90% of investors never get rich because of small mistakes, hidden fees, and poor long-term strategies. Today, I'm going to show you exactly which investment, ETF, index fund, or mutual fund can make you a millionaire in the next 20 or 30 years. Stay with me because this could change your financial future forever. Before we dive in, hit subscribe and turn on notifications so you never miss a strategy that can grow your wealth. An ETF, or exchange-traded fund, is a basket of stocks or bonds you can buy on the stock market, just like a single stock. It tracks an index or sector and usually has very low fees. Some ETFs focus on technology, others on healthcare or consumer goods. For example, the Vanguard Information Technology ETF has returned an average of 12% per year over the last 10 years. An index fund is very similar, but it's usually bought directly from a fund company. It tracks an index like the S&P 500 and is perfect for set-it-and-forget-it investing. For instance, the Vanguard 500 Index Fund has returned about 10% annually over the last 20 years. A mutual fund pools money from many investors and is actively managed by a professional manager who picks stocks or bonds aiming to beat the market. Some mutual funds have outperformed the S&P 500 in certain years. But the fees are higher, and over decades, these fees often reduce net returns. For example, the Fidelity Magellan Fund had years of double-digit growth, but after fees, the long-term average was closer to 6.5%. Now, let's imagine you invest $50,000 in each of these options. ETFs historically average 7.2% annually after fees, index funds around 7%, and mutual funds 6.5%. Fees are 0.03 to 0.1% for ETFs, 0.1 to 0.2% for index funds, and 1 to 1.5% for mutual funds. After 10 years, an index fund would grow to about $96,700, with roughly $9,000 in dividends. An ETF grows slightly more, around $100,500 because of lower fees, with about $9,500 in dividends. A mutual fund grows to about $92,100, with about $8,500 in dividends, but higher fees. Notice how just a small difference in fees costs thousands over a decade. You'll see how those same small fees can cost tens of thousands over 30 years. John, an investor from California, chose an ETF in 1995 with $50,000. By 2015, his investment grew to over $350,000, thanks to reinvested dividends and low fees. Meanwhile, his friend Mike picked a mutual fund with high fees. Mike's investment reached only $290,000 in the same period. That's over $60,000 difference from a simple choice. After 20 years, index funds grow to about $191,000, dividends $28,000, and total fees $2,000. Mutual funds reach about $179,000. Dividends $25,000. Fees nearly $12,000. Imagine losing over $30,000 just from fees. And this is why most investors never hit millionaire status, even if they invest early. After 30 years, index funds reach around $373,000. Dividends $65,000. Fees $3,000. ETFs grow to approximately $400,500, with $70,000 in dividends and only $1,800 in fees. Mutual funds reach only $340,000, dividends $60,000, fees $18,000. Even a 1% fee difference seems small today, but costs tens of thousands over decades. Reinvesting dividends matters more than most people realize. If dividends weren't reinvested in an ETF, the total value after 30 years would drop by nearly $50,000. Some investors diversify into sectors. For example, putting 20% in technology, 20% in healthcare, 20% in consumer goods, and the rest in a broad S&P 500 ETF. Over the last 15 years, this strategy outperformed a single index ETF by 1 to 2% annually. That extra 1% adds tens of thousands over decades. Sarah, a Canadian investor, started investing in a US ETF in her TFSA in 2000. Today, her $50,000 investment is worth over $380,000 tax-free. Even in Canada, these strategies work in RRSPs and TFSAs. Let's break it down with a visual example. After 30 years, ETFs are the tallest bar at $400,500, index funds slightly lower at $373,000, and mutual funds shortest at $340,000. Fees, dividends, and compounding make all the difference. Even small differences in returns or fees compound massively. A mutual fund charging 1.5% more in fees seems insignificant yearly. But over decades, it eats tens of thousands of dollars. Now, imagine investing $10,000 per year instead of a single $50,000. In 30 years, an ETF could grow to over $1.2 million at historical rates. Index funds slightly less, around $1.1 million, and mutual funds closer to $950,000. Stick around because I'll show a strategy to increase this even more without taking more risk. Reinvesting dividends is a powerful tool. ETFs and index funds often do this automatically. For mutual funds, it depends on the fund. Missing out on reinvesting dividends could reduce your total wealth by tens of thousands over decades. Historically, some famous long-term investors have followed similar strategies. Warren Buffett's approach has largely been index-focused for the majority of his wealth outside Berkshire Hathaway. Individual investors who emulate this strategy, focusing on low-fee ETFs or index funds, have consistently built wealth over decades. Even during market crashes, low-cost ETFs and index funds recover over time. While high-fee mutual funds often lag behind because fees continue to reduce net gains regardless of market conditions. If you want to maximize your wealth, start early, invest consistently. Choose low-fee ETFs or index funds. Reinvest dividends and avoid expensive mutual funds unless there's a very specific reason. Stick around for my next video, where I'll reveal the exact ETFs and index funds I recommend today to maximize wealth over 30 years. Small fees, early investing, and consistent dividend reinvestment make millionaires. ETFs slightly edge out index funds over long-term growth, and mutual funds often cost tens of thousands in wasted fees. If you found this helpful, hit subscribe and turn on notifications. Comment below. If you had $50,000 to invest today, which would you pick? ETF, index fund, or mutual fund?